Welcome back to The Explainer, everyone. Today we're talking directly to those of you who really want to build lasting wealth, but, also highly value security and risk management. If you consider yourself a cautious investor, you are in exactly the right place. Today we're going to mathematically break down how to achieve true financial freedom without gambling your hard-earned savings away. We're going to look at the data, analyze the risks, and build a totally safe roadmap for building assets. But before we get into the how, we've got to face a pretty uncomfortable reality. 95%. That's right, 95% of people work incredibly hard their entire lives, meticulously saving their money, but they never actually achieve true financial freedom. And why is that? It's because they rely on a route that society promises is safe, just going to work and saving cash. But mathematically, it is actually highly dangerous. It leaves them entirely exposed to inflation and unexpected life events. Okay, let's dive into this. Because right on the flip side, we've got this tiny 5%. This small fraction of people actually manage to build specific types of assets that make their money work for them. We are talking about income that just continues to flow into your bank account while you sleep, while you travel, or while you're just hanging out with your family. And here's the secret. They haven't necessarily taken reckless gambles. Instead, they've taken very calculated, structured steps to transfer their active labor into passive security. To help you safely join that 5%, here's our roadmap for today. 1. The active income trap. 2. 5 assets for financial freedom. 3. Real estate versus startups. 4. Strategies to minimize risk. And 5. Breaking your biggest barriers. All right, let's kick things off with section 1, the active income trap. It's actually wild how society just accepts a standard salary as totally normal and safe. But in reality, it's a massive point of failure. The active income trap simply means you only earn money as long as you're actively working. You do a freelance project, you get paid. You run a store, you earn only while the doors are physically open. But relying entirely on active work is the ultimate financial risk. Think about it strictly from a risk management perspective. If you get sick, if the economy shifts and you get laid off, or if a project just dries up, your income immediately plummets to zero. That single point of failure is exactly why millions of people run on an endless treadmill but never actually get free. To really hammer this home, let's look at what I like to call the sleep test. The legendary investor Warren Buffett hit the nail on the head when he said, if you don't find a way to make money while you sleep, you will work until you die. Now, for a cautious investor, that quote shouldn't spark panic. It should inspire a strategic pivot. It totally validates your need for stable, passive security. Doing the work once and having it pay you repeatedly over a long stretch of time is literally the only mathematical formula to escape the active income trap and mitigate the risk of life's crazy emergencies. So how do we actually do this? How do we build that passive safety net? Let's look at the solutions. Moving right along to section 2, 5 assets for financial freedom. So our source material lays out a landscape of 5 main asset classes. We're looking at real estate, the stock market, agriculture, digital assets, and business and startups. Now, obviously, each of these has its own unique risk profile. The stock market, for instance, offers dividends and capital gains. Just think about how $1,000 of Apple stock in 2010 grew to over $20,000 today. But it requires serious, disciplined education to weather the volatility. Agriculture taps into massive, consistent food demand, which is incredibly stable. Meanwhile, digital assets like online courses or a YouTube channel allow you to build something once and scale it globally without any location limits. But for today's explainer, we're going to focus our deep dives specifically on 2 highly contrasting paths. We're going to do a direct risk comparison between historically the most stable asset out there and one of the most volatile yet lucrative ones. Which brings us perfectly to section 3, real estate versus startups. And this brilliantly illustrates the 2 extreme ends of the risk spectrum. On side A, you've got real estate. It's the oldest, arguably most powerful asset out there. Why? Because it hands you steady monthly rent and solid long-term capital appreciation. It is physical, tangible security. But then, over on side B, we have startups and business. A successful business is essentially a money-printing machine that you personally control. We're talking massive 10x to 50x returns if the business takes off. But as the source explicitly warns, startups are inherently risky. It's the ultimate showdown of slow, steady reliability versus unlimited but high-risk scaling potential. Let's actually ground this in some hard data so you can accurately weigh that risk. On the real estate side, say you invest 5 million BDT for 2 small apartments. That can generate a super predictable yield of around 25,000 BDT per month in steady rent. That's roughly 300,000 BDT a year in highly reliable passive income. Yes, it requires massive initial capital, but the yield is incredibly safe. Now compare that to the startup side. You might only need 200,000 BDT to launch an online clothing store. The initial capital at risk is tiny compared to real estate. Sure, your initial profits might be pretty small, but by building your brand, that monthly income can scale to hundreds of thousands. You're essentially trading heavy capital requirements for a much higher execution risk. For a cautious investor, looking at those two options might feel like a stark choice between locking up all your cash or risking it all on an idea. But rest assured, both paths can be aggressively de-risked if we use the correct analytical strategies. This leads us right into Section 4, Strategies to Minimize Risk. So the crucial point is how we actually step into the real estate market without over-leveraging ourselves and taking on dangerous debt. The biggest mistake people make? Waiting years and years to buy some massive dream apartment, leaving their cash totally exposed to inflation in the meantime. Here is a step-by-step strategy to de-risk real estate. Step 1, start with what you have. If you have 2 million BDT, buy a smaller apartment now. Just get in the game. Step 2, hold it, let it appreciate, and sell it after 2 to 3 years for a profit. And finally, Step 3, combine those proceeds with your ongoing savings to buy a larger unit. This strategy avoids the fatal mistake of waiting too long and lets you build your asset base safely over time. Now, what about the other side? How on earth do we de-risk the wildly volatile startup path? Well, the formula here is mathematically pretty simple, even if it takes some serious discipline to pull off. Startup de-risking means you absolutely must start small, gain direct hands-on experience, and only scale slowly once the business model is actually proven. By keeping your initial financial investment incredibly low, you strictly cap the downside risk. You're basically paying a tiny amount for the real-world education required to run the business. You only pour more fuel into the machine once you know for sure it prints money. Whether you choose the tangible safety of real estate or the calculated de-risk potential of a startup, the overarching lesson here is exactly the same. We have to stop saving blindly and start strategically converting cash into assets. Finally, let's wrap things up with Section 5, Breaking Your Biggest Barriers. I want to leave you with a real thought-provoker today. What is the single biggest barrier preventing you from building assets right now? Is it a lack of money? Because as we just saw, you can actually start a business with very little upfront capital. Is it a lack of knowledge? Well, that can absolutely be acquired through careful study. Or is it simply fear? For us cautious investors, the fear of losing money is a massive deterrent. But remember that active income trap we talked about at the very beginning? The greatest financial risk you can possibly take is doing nothing and relying entirely on your active labor. Take these strategies, pick the asset class that best fits your risk profile, and start converting your cash into true financial freedom. Thanks so much for hanging out with me on this explainer, and I'll see you next time.